We're just about to start the US Q3 earnings season, and that's going to be critical for this upside to be maintained. The expectations of analysts are currently that earnings will be up 7.9% year on year. Typically, companies come in and beat that, but woe betide them if they don't. Welcome to Key Points for October. Now this month we look at the Federal Reserve. They've started cutting rates again. How much further can they cut? We turn our attention to the massive surge in business investment in the United States and ask, is this a signal that the AI boom may be coming to an end? And of course, as always, we look at the financial markets where we suspect there's still further to run for these equity markets globally. Now, turning to our first point around the Federal Reserve, well, finally, they've started cutting interest rates again, much anticipated, and we spoke about this last month. If you look at the chart I'm showing you here, you can see that they had paused for 9 months as we had still sticky inflation and still a very tight labour market. Well, finally, they've decided to cut rates again, but by only 25 basis points. Now, this was really as expected. But when we look at financial market pricing currently, the financial markets suspect the Fed will cut by another 4 times. In other words, 100 basis points of further rate cuts. Now, we suspect that's maybe just a little bit aggressive. When we look at the inflation dynamic, inflation is still way above the Fed's target, roughly about 3% and rising. And we see service prices also very sticky, still currently around about 3.6%. So we suspect the Fed will be a little more cautious on the current market pricing, but the direction of travel nonetheless is for lower rates in the United States. Now, this is also the case globally. The chart I'm showing you here is one that we keep track of, which is looking at the number of central banks that are cutting versus the number of central banks that are hiking their policy rates. And as you can see, the latest reading shows that 60% of the 43 central banks that we cover are now cutting interest rates. And that's because both growth has been slow and below trend in most parts of the world, and inflation outside the United States continues to show disinflationary forces. In other words, there are really no inflationary pressures coming through, and this is allowing them to cut interest rates. Here, we do suspect there's going to be more coming in the months and quarters ahead. Now, turning to our second point, you'll all have read and heard about the massive US investment in AI technology. And if you look at the chart I'm showing you here, you can see that the United States has been very good at investing in its future in terms of non-residential investment over the last 10 years. But look what's happening to the intellectual property side over that period, and particularly this latest tick higher. There's massive commitment by the IT sector to invest in the future of AI. We can see this in terms of the commitments that companies like Meta, Intel, Microsoft, Google are all making. This can be 50, 60, 90% increase in capital spending in this year and next year. And of course, that's driving a lot of euphoria. Now, we're also seeing cross-shareholdings. You'll remember that NVIDIA bought into Intel, for example, and there are other examples of vendor financing. In other words, one company financing another to buy its goods again, this kind of circular finance. And historically, that's been a warning flag that we may be getting to the end of a cycle, or we may be seeing misallocation of capital. Now, so far, we still think this has got further to run. Yes, the numbers are huge, but it's keeping the impetus going in this sector. So while we are concerned about potential misallocation of capital, we suspect we're not there yet, and we're going to see more of these commitments, more of these investments in the months ahead. Now, turning to our third point, we believe the uptrack in equities is likely to continue, driven by that technology spend that I've just been mentioning. If you look at the chart I'm showing you here, you can see the MSCI World Index has done very well really over the last 5 or 6 months, up about 15 or so %. But look what's happened to some of these other markets that are heavily exposed to technology. In the case of Korea, it's up massively. It's also true in terms of the Chinese market and, of course, the US tech-heavy NASDAQ itself. In other words, the momentum, the drive is clearly in the technology space. And given what I said about business investment, we see further upside ahead. But we're just about to start the US Q3 earnings season, and that's going to be critical for this upside to be maintained. The expectations of analysts are currently that earnings will be up 7.9% year on year. Typically, companies come in and beat that, but woe betide them if they don't. Expectations at 7.9% are quite high. We do think there's further upside here, but that will need to come through in order to keep this smooth uptrack in equities going forward. As I said, we think there is still something to play for here, but there are increasing risks given that expectations have been rising as well. So remember, as always, you can read the full report on Zurich.com, and I look forward to again speaking to you next month.